Thank you.
All right, we'll wait one more minute and then we'll get started. Okay, I think I'm going to get started. What did, Kaylee, did you want to say anything first to start out?
I don't think so. I mean, I've prepped them all for what this is going to be, what this is going to look like a little bit, but I appreciate everyone being here. I think it's really important as we make some of these changes. So
Awesome.
thank you. Yeah.
Okay, well, my name's Scott Wieland. I'm the agent or the broker who works with Ecco to figure out what the best plans are going to be going forward each year. The good news, for the most part, is that the overall premium is not increasing very much. And we're sticking with Dean for another year. And the network actually expanded a little bit more, so there's more doctor choice than you've had in previous years. So for the most part, it's all good news. And what I wanted to do is make sure that I went through all of the information. The biggest difference between this year and previous years is that the rates now are what they call composite rated instead of age rated. So in the past, depending on what your age was, it could be a dramatic difference of what the cost is for the same plan for two people. That one was if one was 25 and one was 40. Now everyone's single rate is the same. And so going forward, the rates will always be composite rated. So the single rate will always be the same, employee spouse will always be the same, et cetera, going forward. So it's going to be a little bit different than it used to be. And some people's rates might go up a little bit more than they were in the past. Some people's rates actually could go down. But going forward, that's how those rating structures are going to work. Um, what I wanted to do was make sure that you guys were aware of the two plan choices that you have to choose from. Talk a little bit about the network, talk a little bit about the other value added things that Dean offers, and then quickly go through the dental. And then after that, Bill Vinny, who is also on this Zoom, is the expert on health savings accounts. And if you choose the Silver 5100 Dean Health Plan, then you can set up a health savings account, which would allow you to save quite a bit of money in tax savings on known expenses that you're going to have anyway. So that's a huge advantage of picking that plan is being able to set up a health savings account, and Bill will walk through how that works. So I'm going to attempt to share the screen here, and hopefully this works. Knock on wood. Okay, can you guys see my screen with the
Yeah.
Dean plan?
Yep.
Excellent. Okay, so there are two different plans that you're going to have to choose from. One is a copay plan design that has copays for primary care and specialty and emergency room visits and prescriptions, etc. And then the other plan is all deductible. So everything would apply to the deductible. When you meet the deductible, then everything's 100% after that. Same two plans in an essence that you've had in the past. So not a lot of change, but we wanted to make sure that you understood how they worked. So the first plan that you can see here is the copay plan. It has a $1,500 deductible for a single participant. And then coinsurance kicks in where you pay 20% and Dean would pay 80%. The maximum out of pocket is $6,150 for any individual. If you ever hit $6,150 that you've paid in a plan year, which runs December 1st to December 1st, then Dean would pay 100% of all charges after that for the rest of the plan year. For a family, it's 3,000 deductible with a 12,300 maximum, but no more than 6,150 for any one individual in your family if you have family coverage. As you can see here, there's co-pays, $30 for a primary care visit, $60 for a specialty visit. Prescriptions are 10, 40, 75, or 150. All of those co-pays do count towards your maximum out of pocket of 6,150. So if you go to the doctor and you pay $30 copay and then he gives you a prescription, it's a $40 for the copay for the prescription. That $70 is applying to your maximum out of pocket. Okay. If you hit that 6,150 limit, the copays even go away and you don't pay any copays or anything. Everything's at 100% the rest of the year. Okay. I need to try to move that over so I can scroll down. The second plan that you have to choose from is what they call a high deductible health plan. And what that term means is that there are no copays involved. Everything applies to the deductible. And then once you hit the deductible, your max out of pocket is also the same. So you can see that it's a $5,100 deductible. And then it's also a $5,100 max out of pocket. Okay. The way this plan works is pretty simple. Everything is going to apply to your max out of to your deductible, including prescriptions, emergency room, durable medical equipment. Anything is going to apply to that, and you're going to pay 100% of the cost of it. Once you hit $5,100 max out of pocket, then you'd be paid at 100%. Dean would pay everything the rest of the year. This plan is less expensive, and I'll walk through the cost of that of what each plan would cost. But it also has, if you remember on top, there was a 6,150 max out of pocket for the copay plan. This actually has a lower max out of pocket, even though it's less expensive. So that's another advantage of this plan is you would actually, your worst case scenario, if you knew you had a very large expense coming up, I don't know if you're going to have a baby or if, you're going to have a surgery that you're aware of or something along those lines. The max out of pocket is the most important thing because that's when it cuts off and you get paid at 100%. Even though the silver plan is less expensive, it actually would be $1,000 less of exposure from a claim standpoint. So if you have a known large expense coming up in the upcoming year, or every year you have a lot of expenses and you hit the max out of pocket, you might want to look at this high deductible health plan because the max out of pocket is lower. Okay.
Scott,
Yes.
there might be somebody in the waiting room right now. Do you see Nicole?
Let me double check.
Okay, thanks.
Let's see. Don't know how to get back to not sure how to get back to the main screen even.
Okay. Well, it's being recorded as well, so I can let her know that too.
Okay. Yeah. Should be easy enough. You'd think. It's got most of
Scott,
the.
I think you need to stop sharing first and then go back.
Do I?
Yeah, I don't think you'll be able to do it from the share screen.
I don't even know how to stop sharing.
Go back to the share button and then.
Yeah, it sounded really small. Because I'm talking, it's like I don't have the full screen, so I can't do a lot of the stuff. I'm not sure. Oh, there it is. Okay. Oh, there we go. Okay.
Okay.
Stop share. Okay. All right. Stop sharing. Participation. I don't want to keep on making everyone wait here, and I don't.
Okay. Yeah, that's fine. I'll let her know it's.
Oh, there we go. Okay. Finally found it. Okay. Nicole's in. Yay.
Okay.
That was easy. Okay, I'm gonna attempt to. I'll
Go back
attempt
to
try
sharing, because sharing is caring, Scott.
Yes. Oh, hopefully, I am sharing right now. Am I sharing again or not?
Not yet.
Okay, here we go.
There you
Here it comes.
All
All
right.
right.
Success.
Yay, yay me.
Nice work.
Okay, so any questions on the plan design? I'm sure Nicole has some, but any questions on the plan at this point? Or the plan
No, I don't think
options?
so.
Okay. So just so you guys are aware, Kaylee, I assume that you were going to share the costing with everybody. But just so you're aware, just to give you an idea of what the cost would be for the employee portion, Ecco's picking up quite a bit of the cost, especially on the single side. So the cost, especially for a single, is very, very cost effective, I think. Um, so the gold copay plan for a single participant would be $212.54 a month. So if you get 2 paychecks a month, whatever that, that's going to come out to half of that. So that's a monthly amount is 212.54 for the copay plan. If you pick the silver plan or the high deductible health plan that we discussed, your cost per month would be $147.21. So Kaylee can share the cost for the employee children and the employee spouse and the family. There's 4 tiers, so it's a different rate for each one of those tiers. But that gives you an idea of what your cost portion would be for those 2 different plans. So the high deductible health plan is about $65 less a month than the copay plan. And like I said, it does have a lower max out of pocket. Now, obviously, with no copays, you're going to get to the maximum out of pocket quicker. But that's what that is. The one thing I didn't mention earlier is that preventative coverage, anything that's deemed as preventative, is covered at 100% under either plan. Okay. So if you go for your annual physical, whatever is deemed as preventative would be covered at 100%. Now, that doesn't mean that everything at your annual physical is going to be deemed as preventative. So you'd really want to make sure you talk to your doctor at the time that you're getting your annual physical and say, hey, I'm assuming everything's going to be preventative. If something's going to be diagnostic, maybe we don't want to do that today. I had a situation when I had my annual physical where they're like, oh, we're going to do all of this blood work. And I assumed everything was going to be preventative for that blood work since I was at my preventative visit and there was no diagnosed thing. Anyway, some of the blood work came back as diagnostic because they don't cover it under preventative. So I had to end up paying some stuff. So just be aware that you might want to have that conversation with a doctor when you go for your annual physical.
Good to know.
Yeah, I know. I was surprised. I'm like, why would you order something that's not preventative? Am I preventative?
Yeah, well, and if you don't ask, nobody tells you.
Yeah, that's exactly right. Okay. Can you guys see that I switched to a different thing?
Yes.
Yep.
Okay, yay. Okay, so as I mentioned earlier, you are now going to have a more expanded network of doctors than you had in the past. In the past, you had what they're called their focus network. The focus network is basically the SSM clinics or the deemed owned clinics, and then it had Wildwood Clinic as well in Dane County. And then outside Dane County, there was other SSM clinics, but that was basically what your choices were. The network is now their full commercial HMO network, which includes the Dane County network is very, very similar. But if you doctor or live outside of Dane County, you're going to have a lot more choice than you've used to have. It's now going to include like upland clinics. It's going to include a handful of UW clinics outside of Dane County. It actually even includes 2 clinics in Dane County that are UW, the UW Verona Clinic and the Northport Clinic. But just be aware, it's not including all UW clinics. It's just those 2. And that's because there's no Dean Clinic in Verona. So they rent basically the UW Clinic in Verona. But it also still includes all the SSM clinics that you've gone to, et cetera. So it includes all the doctors you've been going to, but now it includes, especially outside of Dane County, a lot more choice. So that's a positive. I am going to scroll down to some of the flyers that are included here. So just a reminder about the wellness program. You can earn up to $150 per year for doing healthy activities, such as doing an online health assessment, getting your annual physical, getting a dental exam, recording your healthy activities, such as walking and stuff. So it's pretty easy to get the $150. And the Living Healthy program is what it's called. And you can go to the deancare.com/living healthy to get more information. But basically, you sign into your online Dean account, and then you can track that information and request the payments and stuff. Also, a reminder that they do have e-visits and video visits, which would save you money. The e-visits are basically you go online, you fill out like a online questionnaire, and then they're either going to email you back or tell you they want to set up a call, etc. It's for things such as cold, allergies, rashes, things of that nature that can be done over an e-visit. If you have the copay plan, e-visits are free. If you have the high deductible health plan, they're like $39. So it's way cheaper than if you walk into the doctor's office and they want to charge you $150 to do the same thing. The video visits are basically what that sounds like. It's an online video visit with their doctor or a doctor at the Dean Health Plan. Once again, I think it's like $59 or less for the video visits, so it's cheaper than if you go for your primary care. So keep that in mind that those are a couple ways that you can save some money. The pharmacy concierge service, if you take ongoing pharmacy items, especially if they're not generic or the lowest cost, really consider looking into the concierge service where they can kind of walk you through and help you navigate what might be the best solution for you and if there's cheaper options for you and all of that good stuff. So keep that in mind. Here's other ways you can save money. Mail order on drugs is take generics, mail order. They have certain drugs that are $0 copay. So you can look into those items. Oh, I already talked about the e-visits and the video visits, so hit that. And as I mentioned on the preventative care, there's a chart here that shows what in general is preventative and then what services are non-preventative if you're at your preventative service. So all of these flyers will be available that Molly, when she does your one-on-one with you, can email you all of these flyers, etc. I'll also make sure that Kaylee has copies of all of these flyers that she can get to any of you if you have wanna see this information. Okay. Any questions about anything I've talked about?
Not yet.
Well, that is awesome. Okay. That wraps up, I think, most of the stuff on Dean. So I was going to move over the dental unless you guys have any further information that you want to me to discuss on the Dean portion. Okay. All right. So the dental rates basically stay the exact same. So that's good news. Is your dental rates? You can see the dental rates here on the information here. That's what the monthly rates are for the dental. As a reminder, how the plan design works, you have a $50 deductible that does not apply for level 1 services. So your cleanings and things like that only applies to level 2 and 3. Level 2 and 3 is your basic restorative is basically fillings. It also includes simple extractions, periodontal service, root canals. So quite a few things fall under the minor or basic restorative for the 80% coverage. Okay. And then your major stuff is going to be crowns and dentures and fixed, bridges, etc. So implants. So that's coverage is at 50%. So it's 100% coverage for your cleanings and, twice a year services, 80% for those minor and basic restorative things, and then 50% coverage for major things. The max benefit per year is $1,000 that Momentum would pay out, but it's really more than that because your level 1 services don't count against that $1,000. So if you assume that those twice a year annual visits with x-rays, etc., might cost $200 a piece, that's $400. Really, you're getting $1,400 of benefit when you include that $400 of level 1 services that don't count against you. Okay. So it's really nice benefit. So for a single person at $34 for a total cost, to get $1,400 worth of potential benefit is really good. The provider services. Oh, and just as a reminder, you can see that the coverage is the same in network and out of network. So they call this what they call a passive PPO, which means that you can go to any dentist in town you want. There's no restrictions at all. They're going to pay 100% for diagnostic, 80% for basic, 50% for major, no matter where you go. Okay. The caveat to that is if you go out of network, what can happen is they do a thing called balance billing. And the way that would work is, let's say you're going to have a filling done. So you're getting 80% coverage for this cavity filling. If Momentum says that they shouldn't have to pay more than $200 for this cavity be done, and that you're going out of network and they charge $270, Momentum would pay 80% of 200. Then you would be responsible for 20% of 200 plus the additional $70. So that's where that balance billing comes in. If you go in network, the in network providers have agreed to never balance bill you. So they'll never charge more than what Momentum says that charge should be. So you'll never get a surprise. Oh, geez, I have to pay an extra $70 or whatever it is. So if you go in network, you'll know that you'll never have that happen to you. If you go out to the Momentum website, you can look up and do a search by certain number of miles or by a specialty, etc., to look up the in-network providers. They have a lot of in-network providers, probably about 60% of the providers in and around Madison. So this chart here shows you every dental clinic they have in and around Madison that is in network. So you can see there's a ton of choices. I need to let Bill get going here because it says I only have 10 minutes left. So Bill is going to talk about health savings accounts, and I'll let him take that over.
All right. I will share and I will get, if I'm able to share. So, Scott, you need to disable your
I
share
need to
first.
unshare. Yeah. I'm going to stop sharing.
All right. And now host disabled attendee sharing. So I am not able to share mine currently.
Yeah. Now, all right. I just changed that. Can you share now?
And hey, all right, here we go. All right, we don't have a lot of time, so I'm going to get going here. That slide was from our compliance department saying I'm not giving you tax advice or investment advice. UMB, basically, we are your HSA administrator. We're a bank based out of Kansas City. We've been a top-rated HSA by Morningstar Investors Business Daily. But that's not important right now because we don't have a lot of time. So again, how do HSAs work? You have that second plan, that silver plan. That's an HSA qualified plan. Like Scott mentioned, you are responsible for everything up until the deductible is met outside of your preventative care. The government says if you have that type of account, you get a tax advantage health savings account to help offset your costs. So you own it, you manage it, and there's some tax advantages to this particular account. You have to be in that plan. You can't have any other co-coverage that's not HSA eligible, like a spouse's flex spending account or Medicare, things like that. You cannot have that and the HSA qualified plan to contribute. You can only be covered by an HSA qualified plan. So again, an HSA triple tax advantage, money goes in on a pre-tax basis. You can also make contributions outside of taxes that are tax deductible. Earnings and growth are tax-free in your HSA. So you get some savings account interest on the base deposit account. We do also have investment options. So if you build up a balance, you could look to put money in some mutual funds for tax-free growth. And then also those qualified medical expenses are also tax-free. So the benefits, again, you get that triple tax advantage, long-term savings. These funds roll over year to year to year. They don't go away. It's going to lower your costs because you're paying with pre-tax dollars, and you're also paying lower premiums on that specific health plan. You decide how much you put into the account up to the federal limits. You decide how you spend it, if you're going to invest. And again, you always own this. If you change jobs, you retire, whatever's in your HSA, it's still always going to be your money. So the funds are portable. It's not a use or lose. All right. Like I mentioned, you want to try and maximize as much as you can through pre-tax. That gets you those extra payroll tax savings. But if something does come up, you can send funds into your HSA on a post-tax basis to get your state and federal deductions on that there. The government sets the limits each year on how much you can contribute. You get $4,300 if it's only you, $8,550 next year if the insurance covers more than one person. If you're 55 or older, you get an extra $1,000 catch-up contribution. If you don't meet these contribution limits, you do have up until tax day to make the contribution for the prior year. You do want to let us know if we just see $800 get deposited in March and you want it for that prior year and you didn't tell us, we're going to count it towards that calendar year that hits the account. So you do want to reach out to our customer service team and go through how you make that prior year contribution. All right. Distribution, again, you are responsible for record keeping. We have a receipt vault for you to store those receipts. You don't have to submit receipts to anybody, but the IRS could ask to audit your HSA, so you want to make sure you keep records. Non-qualified expenses are a 20% penalty, and then you also have to claim it as income. And qualified expenses have to be for things that happened after the account was established. They are tax-free. There's no time restriction on reimbursing yourself for an eligible expense. So if you've opened your account, maybe you didn't have enough in there for the expense, or you didn't have your debit card with you when you bought something, you paid for something out of pocket, you can always pay yourself back as long as the HSA has been established. And then remember that you can use the HSA on you, a spouse, any tax dependents, even if they're not covered under your insurance. So if you're married and you have a spouse that has insurance through their employer, or maybe the kids are on your spouse's insurance, you might be limited to the individual contribution amount, but you can still use your HSA funds on your family. All right. What's qualified, like Scott mentioned, anything that's tracking towards those deductibles, those prescription drugs, doctor visits, a lot of things that don't track towards your deductible. Over-the-counter medicines, feminine hygiene products are now eligible. They had those at the start of the COVID. Dental treatments outside of teeth whitening, because that's cosmetic, chiropractor, acupuncture, eyeglasses, LASIK, contact solutions. So a lot of uses outside what's tracking towards your deductible as well. Our account, there's no minimum balance, no monthly maintenance fee. You do have a paper statement fee of $1.50. Sign up for e-statements. You can avoid that. If you decide to invest down the road, it's $3 a month on that. Investment, we call our brand called HSA Saver. And again, all the investments growth would be tax-free. They can lose value, just like any other investment can. So again, caution on that, but it's the biggest way to potentially grow your funds with those investment options. You do have to keep $1,000 in the basic account. So how to open the account? I missed a 0 there on that enrollment verification number. We need another 0 here. But that should be an ease for you. You put in the code. It'll take you through a few steps. You'll get a confirmation. You do want your social date of birth handy. And if you're adding a debit card for a spouse, you want to have their social and date of birth handy as well. Then in about 5 to 7 days, you get a welcome letter. You get your debit cards a few days after that. So I hope I am under that 10-minute time limit. But again, some takeaways. These are great ways to pay for your family's current and future medical expenses. HSA plan premiums are lower than the copay plans. You get the extra tax savings. The funds are portable. It's always going to be your money. And then because they are portable, you can take HSA funds into retirement. There's a lot of articles out there why HSAs are a secret weapon in retirement. So without further ado, I'm going to stop sharing. Questions on HSAs?
No.
Whew. If there are any questions, I'm more than happy to get my email address, shoot me an email. We can set up a time to call and go over any individual questions if you'd like.
Sounds good.
All right, Scott, back to you.
All right. Well, I think that's all we have. The plan starts over December 1st. That is the open enrollment period where you can come on. If you don't have any other coverage, you can come on anytime during the year. If you lose other coverage, you can come on first of the month after that. But all the deductibles and max out of pockets run December 1st to December 1st. So those will be starting over on December 1. You can choose either plan at this point. So, this is your chance to swap from one plan back to another. If you do take the HSA plan and you're switching back over to the copay plan, you'd want to probably talk to Bill Venny. He can give you some information about what you need to do in regards to that as far as prorating your maximum benefit into HSA. But I'm assuming that if you're on the HSA now, you're going to continue doing that. And I would think that a lot of you would want to do the HSA going forward down the road. So that's all I have. Is there any other last second questions before it cuts out on me in about 2 seconds? If not, I appreciate you guys listening, and this will be recorded. So if you miss anything or want to listen again, you can go back in and do that.
Thank you.
Thanks.
Thank you.